Welcome to the deep dive. Today, we're taking a closer look, a real analytical look, at a major shift happening in Gulf real estate. We're talking about the rise of Ras Al Khaimah, or RAK, as maybe the next big investment area. Our source material for this is a really focused investment analysis. It's looking at the BNW Taj Wellington Mews development on Al Marjan Island. And this comes from Dr. Pooyan Ghamari, the Swiss economist who founded the Alien platform. So it's got some weight behind it. The goal here isn't just to talk about one building, though. It's more like using this project as a lens to see RAK's bigger evolution.
Exactly. And for you listening, I think what's really interesting is how capital moves, how investment landscapes change. For so long, the UAE property story was basically Dubai and Abu Dhabi, a duopoly.
Right.
But this analysis suggests that as those big markets mature, maybe yields get a bit tighter, the smart money starts looking elsewhere. And RAK is, well, it's deliberately putting itself forward as that next high-growth territory. The report is pretty direct about it. It calls the Taj Wellington Mews project pivotal. So not just another successful launch, but a signpost, a signal that RAK entering a new phase, a more integrated one.
Okay, let me jump in there. RAK has traditionally been, well, quieter than Dubai or Abu Dhabi. What makes Al Marjan Island specifically suddenly so strategic? Why is it more than just, a nice spot by the water?
Well, the analysis uses this really striking phrase. It calls Al Marjan Island a deliberate geopolitical and economic tool. That's quite a claim. It suggests it's not just market forces at play, but state strategy trying to reposition RAK globally. And the thinking behind it, the economic logic, seems to consciously echo what made, say, Dubai's Palm Jumeirah such a magnet for capital years back.
Right, the Palm Jumeirah playbook. But is it just about branding and saying the right things? What's the concrete action behind it? Building a tool like that needs real investment.
Oh, absolutely. And the source confirms that. We're talking billions committed by the RAK government over the last 5 years, focused on fundamentals, better transport links, more hotels and hospitality capacity, and, crucially for investors, getting the rules right, aligning zoning and ownership laws with what international investors expect. That regulatory piece is key.
Okay, and then there's the catalyst everyone's talking about, the Wynn Resort, the first integrated resort of its kind in the whole Middle East, landing right there on Al Marjan. That feels like a really big deal.
It is a game changer. Bringing in a global name like Wynn doesn't just add another hotel. It creates this huge structural tailwind. It's expected to significantly boost tourism, obviously, which then directly feeds demand for residential property and supports pricing. And that ties into this concept the analysis highlights, the destination ecosystem. Al Marjan isn't just random developments. It's master planned so that luxury homes, branded hotels, shops, marina, they all sort of support each other. For an investor, that integrated approach is really important. These ecosystems tend to do better than standalone projects because demand is more sustainable, it compounds.
So the bet isn't just on RAK rising and on this specific, controlled, integrated environment succeeding.
Precisely. You're investing in the whole coordinated plan, not just an isolated building.
Let's talk about the developer then, BNW Developments. The analysis notes they're younger compared to the big established players in Dubai. They're competing on vision, it says, focusing on these lifestyle design-heavy projects.
Vision is one thing, though. Delivery is another, especially in real estate. How does a younger firm guarantee quality and timelines in such a high-stakes market? Isn't there an execution risk?
That's a really important point. Does that risk maybe cancel out some of the benefit of getting in early?
It's definitely something to watch. The analysis sort of counters this by focusing on the type of vision. They're aiming for something different. Look at the Taj Wellington Mews design. It's described as a mix British architectural style meets modern Gulf design. It's a very deliberate choice, likely aimed at signaling a certain sophistication to global buyers.
Interesting. So moving away perhaps from the all-glass towers we saw so much of, who's the target audience for that specific blend?
The source mentions targeting investors from Europe, South Asia, the Middle East, sophisticated buyers. And the argument is, these buyers are looking beyond just square meters. They want the story, the status, the tangible long-term value that comes with a branded lifestyle residence.
Okay, let's connect that design and lifestyle vision back to the numbers. What about the amenities, the concierge, spa, co-working spaces, pools? That level of luxury usually means higher service charges, which could impact net returns, couldn't it?
It could. But the analysis argues these features actually strengthen the investment case. They justify premium rental rates. By offering these resort-style amenities, the project aligns with what high-end, long-term tenants want. and also taps into the growing short-term rental market that RA's tourism push is creating. So yes, costs are higher, but they underpin the ability to charge more and attract better tenants, hopefully boosting gross yields.
Right, it supports the premium positioning.
Exactly. So if you put all together the government backing, the Wynn factor, the ecosystem plan, the developer's vision from an investor's viewpoint, it looks like a convergence of, well, three key dynamics.
Okay, let's unpack those dynamics. The first one seems to be about timing.
Yes. The first is early-stage entry into a rising market. It's about value capture. RAK is still considered early innings in its big transformation. The analysis explicitly says Al Marjan Island seems undervalued relative to its potential compared to mature Dubai waterfront spots where yields might be lower now. So the opportunity is to get in before the full impact of all this development is priced in. Capture that appreciation over the next, say, 5 to 10 years.
Makes sense. By the potential, what's the second dynamic? It's about the type of property itself.
Correct. The second is the rise of lifestyle real estate as an asset class. This isn't just a standard apartment block, it's a lifestyle branded development. Globally, the best performing residential properties often combine location, design, services, and that sense of community or experience. The idea is that by selling an experience, Taj Wellington Mews can achieve stickier demand, better occupancy, and charge a premium over generic properties.
So the branding and the services act almost like a de-risking factor and a yield booster.
That's the argument. It helps secure a stronger tenant profile. And the third dynamic is about portfolio strategy, diversification and portfolio balance. For larger investors, maybe family offices or international funds, owning an asset here offers diversification within the UAE. Its price movements might not perfectly track Dubai's.
Can you explain that less correlated price cycle a bit more? What does that mean practically for an investor?
Sure. Dubai's property market is often heavily tied to global finance, oil prices, big international business migration. RAK's growth, at least right now, seems more directly fueled by this huge push in tourism and regional leisure demand, different drivers. So an asset in RAK could, in theory, perform well based on its specific growth story. Even if the broader Dubai market hits a slower patch, it acts as a bit of a hedge.
Got it. So it smooths out regional exposure. Okay, let's get to the assessment itself. The ALIN 100-point developer assessment. It gave the project an 82 out of 100, labeled strong performer with strategic upside. What does 82 actually mean in context?
Well, 82 is definitely a strong score. The analysis suggests it's punching above its weight, especially considering RAK is still an emerging market compared to prime Dubai. The breakdown is revealing. Location strength got a perfect 15 out of 15.
Wow, okay.
Yeah, that reflects huge confidence in that specific Al Marjan waterfront spot and RAK's whole infrastructure and tourism trajectory.
And what other strengths push the score up?
Two other big ones are highlighted. First, its alignment with tourism. RAK wants to triple visitor numbers, which directly helps the case for short-term rentals in a project like this. Second, its appeal for global capital flows. It fits neatly into that trend of people investing for residency. The investment residency convergence, helped by the UAE's expanded golden visa rules. It offers more than just financial return.
But no investment is risk-free, especially in a market that's still developing. What are the main risks investors need to keep an eye on, according to the analysis?
The assessment points to three main areas of caution. The first is execution and delivery. We touched on BNW being newer. So the report advises closely monitoring execution, hitting timelines, maintaining quality standards, especially in the later stages of construction.
And how would an investor monitor that practically, beyond just the marketing updates?
You'd want to look for signs of progress on the ground, maybe check if construction loan drawdowns are on schedule, if major contractors seem stable. Real-world indicators that the promised quality is actually being delivered. The second risk is market liquidity. RAK's resale market is growing, yes, but it's still not as deep or as liquid as established parts of Dubai.
Meaning it might be harder to sell quickly if you needed to, so a short-term flip might be tricky.
Potentially, yes. The analysis suggests that for shorter hold periods, you need a conservative exit plan. To really capture the growth from the island's transformation and navigate that liquidity difference, a holding period of maybe 5 to 7 years makes more sense. Let the Wynn effect mature, let the market deepen.
Okay, a longer-term play. And the third risk brings us back to those luxury amenities.
Right, operational costs. Those great resort-style features come with higher service charges compared to a basic building. Investors need to really scrutinize the projected budgets for these charges now and factor them into their yield calculations carefully. Make sure the net return still makes sense after accounting for those higher running costs.
So balancing the premium appeal with the ongoing cost.
Exactly. Now, if we tie all this together, the upside potential and these risks, what's the playbook for someone considering investing in RAK through a project like this? The report actually outlines 4 investor profiles.
Okay, let's hear them. Who is this best suited for?
First, yield-focused investors. Given the entry price points and the tourism boom, the forecast is for growth yields to potentially beat similar Dubai coastal properties, at least initially. Second, capital appreciation seekers. These are investors betting on that longer-term RAK growth story, the ecosystem effect, aiming for significant value increase over 5 to 10 years.
That makes sense, playing the long game.
Third, residency-driven buyers. For them, the investment provides the added utility of qualifying for long-term UAE residency, like the Golden Visa. It's value beyond just the financials. And finally, diversifiers. These are often the larger players, family offices, funds, looking for tactical UAE exposure that isn't just Dubai, providing that hedge against market correlations we talked about.
It really seems like the timing of this project is central to its appeal. It's positioned to ride the wave of the UAE's broader economic strategy, moving towards tourism, knowledge-based growth, less reliance on just oil.
That's a great summary of the macro picture. And it leads to the final thought, really. Real estate success is so often about timing. Think about investors who got into Palm Jumeirah before it was the global icon it is now, or maybe bought in Lisbon's waterfront districts before the tech boom there. Early positioning can be incredibly powerful. So the question the analysis leaves you, the listener, with is this. Does Al Marjan Island today, with the infrastructure, the government backing, the huge catalyst of the Wynn resort coming, does it genuinely offer that same kind of early-stage opportunity for significant long-term reward? Are you looking at the next chapter of Gulf real estate growth right here?